podcast. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas. And I'll tell you, folks, we are on a momentum right now. Our last podcast was amazing. We got a lot of good press and good reviews from this. And let's continue that on, and we'll introduce Vicky Hutchmala from the Opportunity Zones Marketplace. Vicky, how are you today?
I'm always fabulous, Ron. Everybody should know that by now. And we live in the best place, Vegas, and we have two exceptional guests with us today.
Yeah, we do. We're making a habit out of this. We used to have just like one guest, and our last couple of them were having podcast parties, as I like to call them, people from all over the country calling in, getting on the podcast. So let's introduce our guests right now. And, folks, we've got Brett Siglin. He's a partner in Jennings and Strouss in Phoenix, Arizona. Brett, are you there? How are you doing today?
Great. Hi, Ron, Vicky. Thanks for having me.
And you know what else we've got? We've got another great guest, Bob Micera from Micera Real Estate Investments, and he's also from Scottsdale, Arizona. Bob, how are you today?
I'm doing great. I live in the best place in the country, Scottsdale.
Okay, we'll share.
Yeah, no, I'll tell you, you can't go wrong in Scottsdale. Boy, I'll tell you, I wish I was a better golfer. I'd be there more often.
Well, thanks for having us today. Appreciate it.
Yeah, we really appreciate it. And you know, guys, let's just start off the show real quickly about, you know, we've been talking about opportunity zones, and there's so much to talk about involving trends and everything that's going on with this thing. But let's get your backgrounds first. You know, why don't you tell us about how you got into opportunity zones and your backgrounds in general? And Brett, maybe you start.
Sure thing. Thanks, Ron. Yeah, so my name's Brett Siglin, and I'm currently based at a law firm in Phoenix, Arizona. I've been practicing now for about 16 years. I started my career out of law school in Washington, D.C. I worked at HUD for 4 years, Department of Housing and Urban Development, did a lot of closings in the state of Maryland out of the Baltimore field office, and really got to know multifamily housing market, and got into low-income tax credit and bond finance transactions over the next 10 years, working, you know, from the equity side as well as the debt side. And then just about a little over a year ago now, I made the move to Phoenix, and about the same time, the Opportunity Zone incentive was really taking off, and it's a nice blend of you know, concepts that I've worked on over my career, both on the real estate side, the corporate side, and then, you know, the tax incentive side.
Excellent.
Okay. Yeah. So like, in other words, when you came into, did you know about opportunity zones when you came to Phoenix?
I found out about them about the same time that I made the move. So the act was passed late in December of 2017. A lot of people kind of slept through it. It was part of the Tax Cuts and Jobs Act of 2017. There was an effort for several years to get this incentive passed. It was a bipartisan effort, but it was really because of that tax reform bill that they were able to, you know, get the bill passed. But because there was so much going on at the time, people didn't really catch wind of it until that spring of last year, and it was about the same time that I made the move to Phoenix. It was in April of 2018, and Arizona was one of the first states to enact its opportunity zones, and it was about the same time that I actually met Bob and some others here, and ever since we've been gangbusters.
Yeah, and you know, Bob, I was looking at your resume the other day, and is there anything in real estate that you haven't done? Boy, I'll tell you, I mean, it's crazy. Why don't you tell everyone out there what your background is as well?
Sure. Thanks, Ron. I've spent probably over 30 years in the real estate market, commercial real estate market, and I've done a number of different things, both on the principal side and on the advisory side. I've worked for large institutional companies. Most notably, I've built acquisition platforms for several REITs and been their chief investment officer of these acquisition platforms. So my focus has been a lot on finding good, attractive, risk-adjusted return deals, and that's what I look for in the marketplace. And it's primarily spanned most of the property types across the country, from office, industrial, retail, hospitality. Done a little bit on the build-to-suit side, working with developers around the country. So my platforms have been national in focus. So I've looked at deals all across the country, originally from the East Coast, and moved out to Arizona about 9 years ago to take on a position as a chief investment officer for a REIT out here, help them build and launch a new REIT, and build acquisition teams for that company. But I got introduced, I guess, to this whole idea, the opportunity zone, opportunity fund concept around the spring of last year. That's when Brett and I first met each other and started talking about this. As he indicated, there were a lot of law firms out there that really weren't focused on this in the first quarter of last year, because I remember calling up about 5 across the country, and very, very few, if any, had any knowledge about this. So over the course of that time, became somewhat knowledgeable about the tax law. It is a complex tax structure, and it's taken a number of clarifications from the Treasury to help make the law a little bit more understandable. And I think we're in pretty good shape now, but excited about the opportunity to find deals out there that would fit and qualify under the new tax law.
Yeah, I wonder if they're teaching opportunity zone in law school these days. You never thought that would happen, right?
No.
Well, some of these platforms that you were just talking about, these are publicly traded entities, aren't they?
They are. They're now public.
And when you're talking about a platform that identifies real estate, like an advisory platform, is this something that you just highlight properties on? Is that kind of like a portal? Is that what you mean, or is it more of an investment type of thing for investors?
No, you're actually building a portfolio of assets. So when I say an acquisition platform, you have a defined strategy of what you're going after, the kinds of properties, the kind of return expectations, and these were, under the umbrella of a large REIT, which at the time one was private, became public, the other one was public, and you're, put in charge of building that strategy for these REITs.
Got it. Okay.
That's what I mean by acquisition platform.
Got it. Okay. All right. So now when Opportunity Zones came out a while back, it was the wild, wild west. No one knew anything about them. It was, some people say it's still the wild, wild west, but, the guidelines came out, and then people were confused, and then new guidelines came out, and I think a lot of people were still confused. And I know that there's more information that just came out recently. What are the trends that you're seeing in this industry, opportunity zones? What are people making of this right now?
Well,
go ahead,
let me give
Bob.
you my 2 cents, and then Brett, if you want to weigh in. But when it first came out, I think the most knowledgeable people up front were your law firms, your accounting firms, maybe even some wealth advisors, people in the tax business. Over time now, that education process has spread to a larger and larger audience, including investors. The law was passed so quickly and had a number of gray areas that, quite frankly, from an investor's perspective, which is sort of the position I take throughout this whole thing, it was unclear. And quite frankly, some people were, was like, is this really that, is this really true? Is this good? Because the benefits are exceptional. And, quite frankly, it poses the question of, is this for real? Is the government going to change the law? Is this a scam kind of a thing? So I think the trend has been moving in the right direction. The Treasury came out with some further clarifications in October of last year and April of this year, and really have set the framework now that what I call the public, down to the investors, are now getting further educated as the rest of the service providers have become much more knowledgeable, and it can answer questions more readily and help people understand what this new law means and how it will impact them individually. So I think now with the recent clarifications in April, you're now beginning to see people making the decision to make an investment in some of these opportunity zone funds that have been created, and actual projects coming to the forefront where these are real investments and not just concepts being discussed.
Well, are you finding that now, aside from the service providers, the attorneys and CPAs and such that are now more knowledgeable, are you finding that the local municipalities are also becoming more knowledgeable and working within the process to make it easier to build your project in their location?
I think we're seeing that certainly in the Phoenix Valley, and I've heard the same in other markets. I don't think it's necessarily the case nationwide. I think there's probably some communities that are probably even discouraging some of the development. But to echo what Bob was saying, I think there's certainly service providers. There's tons of law firms and CPAs out there that are much more well aware of the incentive and who might benefit. But what I think we're also seeing is that there's still quite a few investors out there and potential candidates who qualify to invest in these funds that still aren't aware of it. People that are selling their stock, maybe people that are selling businesses, even people selling real estate that might be inclined to do a 1031 exchange. And I think there's still a lot of opportunity to educate those investors and make people aware, especially those that wouldn't otherwise invest in real estate, that this is quite an interesting incentive, and there's really no comparison to it.
Have you found the magic formula to find the investors in your projects?
Unfortunately, no. I think, as Brett has said, it's an education process, and the investors are the last ones getting educated, and that's a process that will continue and is underway. So the good news is I think there's a number of deals out there that are smaller deals. They may be what I call club deals that are in process of getting done. But I think you have to take a step back. In the real estate side of this, development is a time-consuming process. From the time you start and you identify a property, it takes a while before you get that property under contract, before you get that property properly entitled and zoned. Then you got to build it and construct it. That can take a very long time. Some of these initial deals, I think, that have started were in the works before the law became publicized, and just timing-wise was fortuitous for that developer that they happen to be sitting on a piece of land located in an opportunity zone, but that process had already started for that development. Finding a deal from scratch on day one, okay, as this law gets more indoctrinated and more understood by people, there are now deals just beginning to get in the queue, if you will, that will be attractive to investors. But it all takes time, and I think people need to understand it. It's a 10-year horizon, and although some people the incentive to get the maximum incentive, you really have to be invested by the end of this year. Unless they change the rule and give you a little flexibility, they're only going to lose 5% of the benefit, which is not that significant. The real positive to this whole deal is making an investment, and 10 years down the road, being able to walk away with appreciation on that deal that's tax-free. And I think people need to understand that and get comfortable with that. It's not for everybody. It's not for every investor. But
right, and we're finding that, as you say, one of the biggest challenges is just educating people to be aware that it's an opportunity for a benefit and an investment, because without people knowing, nobody can participate.
Right, and a lot of these people, as Brett alluded to before, are not real estate people. I would say the majority of the capital that may be coming from the investor is going to be coming from people selling stocks and bonds. If you look at what's happened over the last decade, the stock market has appreciated considerably. You've had a significant run-up with technology stocks and other kinds of industry sectors where those people may now want to take some money off the table.
Right.
We've had a lot of companies go public, and that's sizable capital gains from that perspective. The other thing is that you've got a lot of baby boomers retiring who've had businesses for 20, 30, 40 years. They now sell those businesses, and they're going to come up with sizable capital gains in their businesses, and this could be a perfect avenue for them to divest some of that capital gain into a real estate investment, as well as achieve the tax incentives. And also, I think there's also underlying this is that mentality of making sure that I've been able to achieve a certain amount of success in life, and I want to pass that forward. So socially positive investments is a key thing, not only among individuals, but even from among some of the institutional companies that I have spoken with who are looking at opportunity funds or want to form an opportunity fund. We have a major need in this country for affordable housing and other kinds of things that will help to serve these underserved markets.
Well, and it works everything works together, that now the economy doing so well is allowing people to have more money from whatever source or however to not only to invest, but to afford the businesses and family units that the opportunity zones are providing. So it's kind of a little a circular situation where it's benefiting everyone.
Absolutely, and I think that's
it really
why
is.
The background of this, you have this law was passed with bipartisan approval from Congress, which today may not be the case if it came to a vote in Congress. It also has the support of the Treasury, as evidenced by the investor-friendly clarifications that they've made in their last two reviews of the law. And the community support. I mean, I've met with a number of economic development authorities and city local officials, which are very encouraging and very positive about trying to stimulate investment in their markets, which may not normally have come about as a result, except for this law. And so they are willing to help with either expedited entitlement processes, other tax incentives, and really cooperate with developers and others that are coming into these markets to try to identify investment opportunities that make sense, that are for the good of the community, as well as going to qualify under the new tax law.
One of the other things that I think the word is getting out among estate planning and the private wealth industry, they might have been slower to pick up on this, but I think there's going to be more and more, as Bob alluded to, businesses and small mom and pop type shops that sell their business, and they've got gain, and they might not otherwise have other tax advantages besides the incentive. Another thing to talk about is there's certain advantages to doing an investment in a qualified opportunity fund over a 1031 exchange, and I'd say one of the most significant advantages is that, as Bob alluded to, you get this exclusion from the built-in gain after 10 years, whereas in a 1031, you can defer the gain, and you can defer, for as long as you hold the subsequent property, but eventually you would be subject to tax on that increase in value. So that's a big advantage.
Well, and plus the 1031, you have to use gains from real estate, where with opportunity zones, you can use gains from the sale of anything.
That's right. Any asset will qualify.
Right,
yeah,
and it expands the money pool.
And the other thing is you don't need a qualified intermediary if you invest in a qualified opportunity fund, whereas with a 1031 exchange, you've got that obligation, and you've got to identify your replacement property in a very short time frame from the
right.
You've got 45 days, whereas here the 180-day requirement applies to both incentives, but there's a little more flexibility when you're investing in a fund.
And plus, even once you decide to create your fund, you have to be careful in who you use to create the entity that is the fund. And if you don't have expert attorneys or CPAs to help you understand how to set it up, and also to understand that there's tax consequences maybe at a state or local or county, city level, that those taxes have to be paid, even though the capital gains tax may be deferred, you still have to deal with state taxes.
No, that's right.
You need professionals to help you understand that, so you're not surprised.
Well, there's also some uncertainty. I'd say one of the biggest open items left to be determined by Treasury is, what kind of reporting requirements there will be. So far, there's not a great amount of reporting required, great amount of flexibility in how you form a fund, what type of entity you can use, and then there's a self-certification process that applies to entities that have been formed, and then they file this IRS form in the following tax year. But there's some other reporting requirements that we expect to receive from Treasury towards the end of the year. So to your point, Vicki, it's going to be more and more inherent that folks setting up these funds, sponsoring funds, hire qualified law firms and CPAs.
Right, who really understand the process. Do you think that simply because there's no history in terms of opportunity zones that you can rely upon to create a database or information about how it works and what we need to know and how we need to report it, that this is just something that's going to happen over time? Eventually, there'll be results of zones that actually had projects that worked, that were successful, and we just need that information before we can decide how to expand rules and regulations.
Yeah, I think that's a great point. I mean, if you look back to the 86 Tax Reform Act, when quite a few changes were made to the Internal Revenue Code, and one of the new provisions that was added back then was Section 42 for low-income housing tax credit. And in the first few years after 1986, you didn't see many deals, and it took quite a few years for that industry to mature, and now they've had 35, 40 years of history, and to your point, I think there's going to be a similar process for these incentive deals.
Yeah, so expanding on
over time.
Yeah, expanding on Vicki's point now, Bob, you deal with a lot of investors, and you come at this from an investor perspective. Based on just what we were talking about, what are some of the things that an investor has to look into before making a commitment to a fund? Are there anything that you would suggest that is important that they should know right from the start?
Well, I sort of break it into 4 different compartments. The first is the project viability. I mean, regardless of whether it's located in an opportunity zone or you can take advantage of the tax incentive program, is the deal on and of itself economically viable? Is, regardless of target cash flow, IRR expectations, is it an appropriate risk-adjusted return? And you have to look at that and say, does this deal stand by itself? Does it have appreciation potential? You don't want to have a deal that is not going to have appreciation potential. And I've seen some of these deals. I mean, I've spent probably over a year looking at a variety of deals, and 9 out of 10 deals I reject. There's some reason, for them. Each are different, but you have to look for the right deal to make sure that it's going to be a good, viable deal. Remember, you have lease-up risk. You have to look at the competitive landscape, and you have to look at whether the community is going to be receptive to what you want to do in that opportunity zone. The second thing you want to make sure is, who's the developer? Do they have the right experience and qualifications? There's a number of people that might be sitting on a piece of land that have never developed a project before, and all of a sudden they want to form an opportunity fund and develop it. Well, that adds incremental risk because they've never done development before. And so you want to make sure you select a developer that is experienced, qualified, but more importantly has relationships or contacts with the local authorities and the community, because that's going to be integral to getting your project approved.
Great point.
And moving forward. The third component is, who's the sponsor of this fund? I've partnered with a developer who is used to staying in his development deals because he's done a lot of tax credit and new market tax credit deals, which typically have a 10 or 15-year horizon. Many developers are more merchant build. They want to build and get out. My partner wants to stay in not only as a developer but as the sponsor of a fund, so he's sticking around for the long term. I think that's added value to an investor when you're looking at an investment opportunity from the standpoint of, is the person who built this going to be around, or are they going to be leaving after 2 or 3 years when the thing is completed? And does that sponsor have credibility? Do they have experience in running an operation and managing a property or a portfolio of properties? Are they going to be focused on a particular kind of strategy or diversified? What's their pipeline going to look like if they're doing a multi or pool fund kind of deal? Because, you have time constraints, and there's compliance issues that you have to maintain as an opportunity fund sponsor, because if you don't do those deals or don't comply, the investor is the one that's going to be subject to the penalties, not the opportunity fund sponsor. So those things an investor needs to look at. And the final thing is the investor's outlook. If the investor is looking to, a deal, a time horizon of 3 or 4 years, this is not the right kind of investment for them. They have to have that long-term horizon because the major benefit to this overall tax program comes after 10 years when the property is sold. But they also have to understand and know what their threshold of risk is going to be as an investor, because you're dealing with, regardless of the tax rule, a process, especially that involves development or rehabilitation of existing projects, that has development risk, that has lease-up risk, that has interest rate risk, that has refinance risk. And so people have to place themselves in a bucket of risk, if you will, and say, can I tolerate this risk? Do I have the wherewithal to do that? And I think, that's important. And then finally, related to the investor is, what happens if the fund can't refinance and 2026 rolls around and you now have to pay that deferred tax on that capital gain that you initially sold out of? So you have to be in a situation where you'll have access to funds if the opportunity fund cannot provide you with any proceeds from, to help you pay that deferred tax. And so those are all things that I think an investor has to be evaluating when they look at these kinds of deals.
Well, and that's why...
Go ahead, sorry.
Well, that's why Ron and I have created a new website called the Opportunity Zone Authority, where we can take funds that are listed and certify them so investors can feel that this is a fund that they can have a certain amount of confidence in investing, because the people know what they're doing, they have the experience, they've set the entity, they've created the fund correctly, they've crossed the T's, dotted the I's, and now, you can be assured that there's not going to be fraud involved. So we think that that's important, because it's the details that people have to be aware of that they don't even know they need to be aware of.
And not to mention that the laws and the regs could change again. So
exactly.
It's a moving target. And, to add to what Bob was saying, I think a lot of those same risks apply to investors in a general fund, but there's some timing challenges that are unique to this program that add some complexity, especially with the 180-day requirement. And then the other big one is that, generally from the time, if I'm a fund sponsor or managing a fund and I accept equity, I've got to establish a working capital safe harbor. And if I fail to do that, then I'm going to be in big trouble with my investors. And even after that, I've got a set amount of time, essentially 2.5 years, to put that money to work. So it adds some complication and puts a little more pressure on the sponsors.
Exactly.
Yeah. And Bob,
it goes
Bob,
back
let me ask you a question,
who you're
Bob.
dealing with, and make sure that they know what they're doing first.
I got a question for Bob on what you just said. Bob, can you explain the difference between what you refer to as a sponsor versus a developer? Because I think a lot of people use those terms interchangeably. They're not the same function, right?
No. Just because one is a developer doesn't necessarily mean they are an opportunity fund sponsor. You've seen some large institutional firms form the opportunity fund, and then they've teamed up with a developer to go out and build projects. That developer is just building the physical project, but somebody has to be around to maintain the fund, raise the capital for that fund, and make sure that the opportunity fund is in compliance with all the rules under the tax law. So, and as I mentioned earlier, some developers don't want to be an opportunity fund sponsor. They don't want to have that administration responsibility and compliance requirement placed upon them. They just want to build projects. So they're oftentimes they have not been as interested in doing these deals unless there is a way for them to get out, once they've completed a project and stabilized it, and they can just sell out, have them get bought out by the opportunity fund sponsor, so that they don't have to remain in the deal and they can move on. I typically refer to those as merchant developers.
Mm-hmm. Okay.
And on the flip side, there might be sponsors that don't want to develop, and then there's sponsors that do develop. So it can cut both ways, and you can have a sponsor that teams up or joint ventures with multiple developers.
Yeah, if I was an investor right now listening to this podcast, what I would do is I would actually stop the podcast and rewind it and play the last 10 minutes of this over and over and over again, because these points for the investor were spot on. I mean, they were really, really insightful. And if you don't follow these points we just went over, you could be in for a lot of problems, because the worst thing you want to do is think you're investing in an opportunity zone fund to get tax benefits, and you're not getting the tax benefits, and your project is a dog. That would be a very bad combination, don't you think?
Right,
yes,
and just because you haven't done your due diligence to know what you need to know, and to know that you need to know that is very important. And you know what? You need to know how to put the right project in the right location. Just because if you want to develop a piece of land in an opportunity zone and you put a Whole Foods market in an area where the median income may be $30,000, $40,000, the likelihood of those folks around you are not going to be shopping at Whole Foods or buying a coffee every day at Starbucks. So if you don't put the right project in the right location using analyticals and demographics to make sure that you add a whole nother component to success or not success.
And Vicki, to your point, the old adage that you don't want the tax tail wagging the economic dog, it really runs true here. And there's only so many good sites out there, and I think Bob could probably speak to this. There's a lot of competition for the best deals out there that are in opportunity zones.
Exactly. Every opportunity zone is competing with every other opportunity zone, even the ones that are next door to each other, to get the right project and to develop the location. Cities are competing with each other, counties, states, and individual opportunity zones. So the investor has to be really on his toes to make sure that they're doing the right thing for themselves.
Right. And the other thing, it's not just the real estate you need to look at. It's factors like labor availability.
Exactly.
We've looked at sites where, for industrial, let's just use that as an example, great location, but there's no labor there. Very difficult to build a distribution facility and not have the ability to fill it up with the appropriate labor resources that you need. So if you're going to attract labor to that location, then you need some kind of housing to do that. So, these are all things that, as an investor or as a developer or an acquisition person, we have to evaluate. And it's not just necessarily the numerical numbers. I've had people come to me and say, this is a great piece of location, but the design of the project that they wanted to build wasn't right for the city. Either the box was too big or too small. There wasn't enough demand for that kind of box in that particular market. Or they were guessing at rents and saying, well, you can get this kind of rent or that kind of rent. Well, maybe on the first building, but it's hard to make that decision, because remember, when you're doing development, you have to think 2 years out. So you
right, and just because someone can move into your multifamily apartment complex, it doesn't mean that they'll still be there 6 months down the road. And what are you going to do when you can't replace them with another renter or another buyer? And now you're stuck too, because you didn't anticipate the future.
Right, and here, like for multifamily, which is probably a dominant product type for the opportunity zones, one of the things that you have to look at in some areas, what's the absorption of multifamily relative to the number of rental units that exist there? And if it's a very low number, then that may be a cause for concern. If it's a higher number, that means you have a lot of demand for the need for residential space. And as a result of that, if other developers are building, you may have a higher comfort level that your project will be also successful if that ratio is appropriately, in the right level, if you will. So
that's right.
These are all things that you have to evaluate, the supply and demand of the space that you're going to be in. A lot of these projects are mixed-use projects. They have their own complexities because you may have residential on the top, but then you have retail on the bottom, and we know what's going on with retail. So what's the right kind of retail tenancy are you bringing in? Is it restaurants and coffee shops? Is it the big players? Is it the Whole Foods, Vicki, as you alluded to, or is it a local grocer that's going to be more adaptive to the community in which it's in? One thing that's interesting is I would say 75% of the designated opportunity zones are urban locations, and 25% are more rural. So when you look at that designation, I don't know how many of them are actually good locations from the standpoint. It could be 10, 15, 20% at the end of the day. But it doesn't mean that people can't get creative, like with the rural, opportunity zones. Maybe you put a solar farm on there. Maybe you put
exactly. We did a podcast with Sheldon Mudd, who is working on a rural opportunity zone project in northern Nevada where they're trying to put in a shrimp farm so that they can produce shrimp and provide it to the Las Vegas Strip, to Boise, Idaho, to Salt Lake City, Utah, and also put in the infrastructure, the railway, the roads, all the airports, everything that's involved in that project. And so, like you say, it's rural, and you have to be creative, but it also has to be sustainable. And then you have to build the multifamilies, the residential, all of the things that go with it to support it down the road. But he's doing relatively well. And in Arizona, you have a lot of tribal land, so that's rural, urban kind of combination, but you have to be creative there as well and get the tribes and the tribal elders to be a part of the picture and want to develop it. So creativity is just as important as the specific data.
And following up on that, Vicki, one of the most beneficial rules that came out of the recent Treasury guidance in April is that they made it clear that on tribal land or other land perhaps that's owned by nonprofit or a school or even a community, that it's possible to ground lease that land and still qualify for the benefit.
Yeah,
that's
cool.
Great.
Yeah, we're seeing that here in Scottsdale.
And people have to understand too that Phoenix is different from Vegas. There's very few cities like Vegas in the country, but what works here may not work in Phoenix, and what works in Phoenix may not work in LA or in Salt Lake. So that also has to come into it and adapt it to the type of community and the type of people that live in the community and what their anticipated needs may be. So there's just a lot of details that people need to be aware of, and the reason why they have to hire experts like Brett and Bob to make sure that they can be successful down the road in the future.
And Brett and Bob, you guys broke the internet with the show today. This is really, really great information, and really happy that you guys took the time out to be on. We're kind of running out of time here a little bit, but before we go, if anyone's interested in getting more information, can you guys give out the best way to contact you? You got a phone number, website? What's the best way?
Yeah, I can start if you like. Best way to, this is Brett. I can be reached. My email is bsiglin@jsslaw.com, and my office number is 602-262-5842.
Excellent. And
my contact information is Bob at MiceraRealEstate.com. That's MICERA realestate.com. And my cell number, 201-362-6738 is the best way to reach me.
Love those East Coast numbers, right? Gotta love it.
Yep.
And before we go, Vicki, do you have any closing questions or remarks or anything? This was a really good show. I really enjoyed this.
This was an excellent podcast because it was different because it came from an investor point of view where the investor now has more information than they did before our podcast, and now they can feel confident to call Bob, to call Brett, and do the deal.
Yep. So Brett Siglin, Bob Micera, thank you so much for appearing on the show. It was great to have you. I hope we can get you on again in the future as this whole industry moves forward.
Thanks for inviting us.
Thank you, Ron, Vicki. Really appreciate it.
And everyone out there, you're listening to the Mappable USA podcast at MappableUSA.com. Go to the website, scroll down, you'll see our syndication sources. You pick the one you like best so you don't miss any of our upcoming episodes. And if you want to be a guest today, like Bob and Brett were, there's a guest tab. You can click on that, fill out the form, and we'll see about getting you on the show. So once again, thanks for listening to the Mappable USA podcast, and we'll be at you next week with another episode. Thanks for listening. Have a great week.